Good morning, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com, and this is the week ahead look at the Forex markets for the week starting September 12th, 2022. So let's get into it. First, before I get into the technicals that are driving the market, leading the market, telling us the bias and the risks and all that, let me talk a little bit about the fundamentals that are taking place. This week we had three central banks raise their rates. The ECB raised by 75 basis points, taking the deposit rate to 0.75%. They expect to continue to raise rates further. They saw inflation in 2023 staying elevated around 5.5%, and in 2024 still staying above the 2% target at 2.3%. Growth for 2023 was slashed rather significantly to 0.9% from 2.1% at their prior estimate. Lagarde said that the hikes would likely take place at more than 2 meetings, but less than 5 meetings. So more than 2 is 3, less than 5 is 4. So I guess that means the next 3 to 4 meetings will have tightenings by the ECB. There was a report from sources after the 75 basis point hike that that 75 basis points should be considered at the next meeting as well. So it's still up in the air as far as the October meeting goes. The Bank of Canada raised rates by 75 basis points. That was lower than the previous 100 basis point hike. Rates, however, moved above neutral, which they consider to be 2 to 3% to 3.25%. So they are in the restrictive range now for the Bank of Canada. They will continue to raise rates to bring inflation back down, and the markets still see the eventual terminal rate somewhere around the 4% level for the Bank of Canada. And finally, the Reserve Bank of Australia raised the rates by 50 basis points. That's the fourth consecutive 50 basis point hike for them. They expect to increase the rate ahead, but not on a preset path. And they said it would be data dependent. The current rate is at 2.35%. This week we saw Fed Powell give an interview to the Cato Institute. He reiterated what he said in his 8-minute speech at Jackson Hole Symposium in a 45-minute interview with that institution. Other Fed officials followed along the same path of the Fed chair, where the fight is against inflation. They are not mincing words, saying that they want slower growth. Not that there may be slower growth, but they actually want slower growth. The Fed is now in the quiet mode with the rate decision on September 21st, a week from this coming Wednesday. That leaves the CPI data this week and the PPI data also on be announced this week on Tuesday and Wednesday to be without Fed comment. However, it seemed that the Fed officials were pretty adamant to suggest that don't expect a slowing of the whip inflation now stance, even if the numbers come out weaker than expected. The expectations for the headline CPI, I think, is around minus 0.1%, but the core is somewhere around 0.3% to the upside. So be aware of that. It could come weaker, but don't expect the Fed to change their policy stance for slowing growth and looking for higher unemployment, actually, and keeping the rate hike path going for in the U.S. Meanwhile, in the UK and Europe, they address some of their issues by providing a backstop of support to both individuals and businesses to account for the expected slowdown as a result of higher energy prices. Please go to forexlive.com, and in the must-read section, that's over here, move down to this video, why this could be the bottom in Europe. And Adam here gave an interview to the BNN, that's the Business News Network out of Canada. Please go and listen to that interview right here. It explains all about the fundamentals, what he thinks, and why he thinks that that this may be the bottom for the Europe, which could be good for the euro versus US dollar, of course. So go to that section and please read that. Stocks this week were higher in the US and Europe. Euro yields were a bit higher too, but markets are getting used to that. They're getting used to this path of rate hikes. As the central banks are being very transparent. The US dollar was mixed with modest gains versus the New Zealand dollar this week, and a larger gain versus the yen, but that was off the highs too as well. So we are seeing some yen strength and some dollar weakness, at least at the end of the week. The other currencies experienced gains versus the greenback for a change, led by the euro versus euro, which increased by 0.89%. Dollar fell by that amount versus the euro. This week, U.S. CPI and PPI data will be released on Tuesday and Wednesday. The University of Michigan preliminary comes out on Friday. There's ZU Sentiment Index coming out in Europe, and the Australian Jobs Report on Thursday, along with the RBA Bulletin also on that same day. The UK has a data dump with GDP on Monday, jobs data on Tuesday, CPI on Wednesday, retail sales on Friday. Two final promotions. Also in the must-read section of Forex Live, there is a reminder of the Finance Magnates Summit, which will take place on November 21st and November 23rd in London. So circle that date on your calendar. You can see it right here, all the information about that right here on our website. Also, a shameless plug. Did you know that I wrote a book? It's called Attacking Currency Trends. You can find it on Amazon right here. And I do have a limited amount of copies that I would be happy to sell to you directly. I would appreciate just U.S. and Canada residents, as I've had some issues with sending books overseas that get lost and have to do it again, and so on and so forth. So please limit it to the U.S. and Canada. At this moment, you can send me an email at greg@forexlive.com. It's a good, again, supplement to what I write about, what I talk about, what I try to teach at forexlive.com, so it might be beneficial to you and your trading, especially if you are a new trader. So with that all said, let's get into the technicals that are driving the markets this week. All right, now that the fundamentals and other stuff is taken care of in the first part of the Weekend Forex Report, let's take a look at the technicals that are driving the market. Technicals define risk, they define the bias, they define which way the market is thinking as far as the price action goes. And we had a little shift in some of the movements this week, with the dollar getting a little bit weaker against some of the currencies. We'll start off by taking a look at the euro versus US dollar, see what the price action is telling us. If we take a look at the daily chart here, what we know from the price action over the last few months is that back here in the July into early August, we had a period here where the price stayed within a narrow trading range. Toward the middle of the month, we started to see a move back to the upside here that took the price to another swing area up through here. We had swing low, swing low, swing lows, swing low, and then break below that level, come up and test the high part of that swing area. Also, the 61.8% retracement of this move to the downside also stalled the area near the 1.03612. That started the this failure above this swing area through here, sent the price down, 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 and we ultimately broke through the low of this swing area, and that's where the price has been staying since that time. We developed this other swing area through here, and in trading this week, we saw the price break below that level first on Monday, and then on Tuesday, making the lowest level, going back to 2002 here in the euro versus US dollar at $98. Or at 0.9863, and then on Wednesday we saw the price move back to the upside and move back into this this range area through here, seeing the price move all the way up to the high of this old swing area through here. So, and also to the 50% retracement of this move to the downside. So there is reason to sell against the 50%, reason to sell against the old swing low extreme area through here. And that's what the market did on Friday, closing sort of mid-range for the day. But what is significant from the move to the upside this week, I have to go to the hourly chart. And there are a couple things. One is that the price low that we saw on Monday's trade came down to this level near 0.9877. On Wednesday, or on Tuesday, we fell below that level, making our new low going back to 2002. And then on Thursday, or on Wednesday, I'll get it right, we came down to retest the old swing low from Monday's trade. A lot of times that happens where the market goes and makes a small extreme, then moves back higher, and then comes back and retests the high of the previous extreme right through here and here. and we did it twice on Wednesday before the market then said, maybe it's time to go higher. And indeed, that's what did happen. We moved above the 100-hour moving average. That's positive step number 2 for the upside, and stayed above that, moved above the 200, positive step number 3, and then moved up to this swing area through here. We have to, we're building the story here for the euro versus US dollar. The price, this area had a number of different swing areas, swing levels. You can see them through here, then we moved above it and then came back down up here, right here. Some waffling above and below here, but then reestablished the level here and did it again on Thursday's trade before moving to the downside. This move to the downside was on ECB sources data saying that another 75 basis points may be in play. And at that point, the market took it negatively. We saw stocks move down. We saw the euro move down as well. But reestablished after breaking below the 100 here, support against the 100, traded between the 100 and 200, and then said, oh, the heck, we're going higher. And that's where the market went. We did test the 50% of this move to the downside at the high for the week, and also that swing area that I referred to off the daily chart. That's this area right through here, and then bounced, came back to the downside. What we did see, long story short or short story long, is that we came back to this swing area through here, a number of swing levels, and found support against it, but didn't really go very high. So that's where we get into what's intact for this coming week. Need to stay above this area is my best case scenario for the buyers to push the euro back to the upside. That would be the best case scenario. If the price moves below this level, then we want to see the 200 and 100 start to hold support if the buyers are going to take control. If we start to move below here, it starts to get weaker, and then if we move below the 100 and 200, it gets even weaker and turns the whole bias to the downside. So that's the downside scenario. The holding of this area right here needs to get back above the 38.2 of this move to the downside, and then get its way above the 50% and start to work its way back into the range from the daily chart from this period right here. So that's the goal for the buyers if we're going to push the price higher. That's the only way we can do it. But as you can see, we are trading between some decent levels, and the market's following the technicals fairly well. So pay attention to them. That's the story for the euro versus US dollar. For the dollar versus yen, we moved to a new high going back to 1998 in that currency pair this week, extended to the upside. Two big trend type moves that took the price back above the broken trend line through here and up to our high at 144.98, call it 145 for the dollar versus yen. And then we started to rotate back to the downside on this daily chart. Where do we stall? Friday, we stalled right here against the back the underside, or the old trend line, I should say. We moved below the trend line here, held the 100-day moving average, and then broke above it, accelerating the price to the upside, but came right back down to retest that this old trend line. And so the buyers are still in play, still sort of in control off the daily chart for the dollar versus yen, but we finally did see a move to the downside after 9 of 10 days to the upside for this currency pair. So it is a step in the bearish direction for the dollar versus yen. It was still higher for the week. Taking a look at the hourly chart, this gives us a better understanding of what needs to be done this week in order to keep, if the sellers are going to stay in this game, to stay in control, at least in the short term. If we take a look at the move up from this low to this high, the low price that we saw on Friday's trade came near the 38.2% retracement and found support buyers. But the rally to the upside, where do we stall? Right at the 100-hour moving average, and we sort of sideways our way into the weekend. So from a technical perspective, we have two levels that came in play on Friday. One against the 38.2% retracement, the other against the 100-hour moving average. And that's how we're going to start the week off. If the price can stay below the 100-hour moving average, there's still hope that the dollar versus yen moves back to the downside. We need to get below the 38.2, and then we need to get below the 200-hour moving average, is a green line in this chart, which comes in at 141.30 currently at the moment and moving higher. Recall going back to, or maybe not recall, but going back to this day right here, we can see how the price moved down to test the 200-hour moving average and move to the upside off of that level. So no close below that. And we have to go all the way back to, well, we bounced off the 200-hour moving average here. We have to go all the way back to this date, August 16th, for the last time the dollar versus yen traded below its 200-hour moving average. So folks, going forward, do we need to get below the 200-hour moving average to increase the bearish bias from a technical perspective? Yes. Do we need to stay below the 100-hour moving average to keep the bearish bias for the dollar versus yen to the downside? Yes, that's what we're going to be looking for this week. If we move back above the 100-hour moving average, all bets are off. This bias is still in favor of the dollar versus yen, especially since we found support against 38.2% retracement. So that's the story for the dollar versus yen. Let's take a look at the sterling versus US dollar, and we'll start off by taking a look at the weekly chart, because where did the price low come in this week? At 1.14042. That took out this low going back to the March pandemic low at 1.1408, only by 4 pips. So the price made a new low by 4 pips and bounced higher on the weekly chart, closing here at 115.86 or 90, somewhere around that level here for the sterling versus US dollar. Folks, I lived in the UK. Having the pound down at 1.14 is really cheap to go over there. So if you're planning a vacation, go over to the UK, get some Airbnb or something like that, and if you can get a cheap flight, go do it. It's a great place to visit. So anyway, the price has seen a little bit of a bounce to the upside here, and again, we're going to get our story, our short-term trading story from the hourly chart, because really, you know, the trend is down. You know, going from left to right, the price is to the downside. But what we can say is that there is some rebounding hope. One, off of the low from 2020, the pandemic low, and two, off of the move back above the 200-hour moving average and trading on Friday. The price moved above it here, went up to the 50% of this leg to the downside here in the pound, and stalled, similar to what we saw in the euro versus US dollar. Was it euro? Anyway, one of but we held the 50%, came back down, and retested the 200-hour moving average. The last time the price closed above the 200-hour moving average was not here. We faked a move above that level and came back down. We faked a move above it here as well, but really, you know, I think it's back here where the last time the price closed on an hourly bar above that level. That goes back to, you know, August 11th or 12th or something like that. So staying above that level is key if the buyers are going to, you know, take that currency to the upside and start to sell the dollar a little bit off of its high levels, have some sort of corrective move. We're going to need to get above the 50% of this move to the upside, and then we start to look for further levels on the upside for this currency pair. That would give the buyer some more confidence and perhaps change it to the upside. Of course, the opposite is true. If the price moves below the 200-hour moving average and then the 100-hour moving average, all bets are off for that currency pair. Let's take a look at the dollar versus Swiss franc. We saw another nice technical chart here. We've seen a lot of you know, really trendy light moves here in fairly quick fashion here for the dollar versus Swiss, and then reversals straight off of that, which is sort of unusual too. Reversal to the downside, reversal to the downside, reversal to the downside, and again we saw it this week where the price moved up to a resistance here. Swing high, swing low, swing high, swing high, swing low, swing high, all in this area through here between 0.9871 and 0.9890. Sellers came against that level, that target area, and we started to push the price back to the downside. On Friday, we moved back below the 100-day moving average. We traded above and below through here before the market moved higher. But again, this time moved down and stayed down through that level. Came down to test this old low through here. You know, again, you know, I'm not saying it's the greatest level, but it was one of the swing lows in this up and down type of trading range, because we sort of waffled above and below it through here, but came back down to it. We did base against it here, so, and we did see try to hold above support there. So I consider it somewhat decent. The 50% of this move to the upside is also in play. Let's put a Fibonacci from this low to this high, see what happened on Friday's trade. Went below the 61.8, but bounced up. Here's a 50% retracement of this move so we are below that level. Technically, off the daily chart, we'd want to see the price probably stay below this swing area and also below the 100-day moving average. On the downside, it would be nice to get back below the low that we saw on Friday again, which was a low here, low highs through here, and a low going back here. That would open the door for the downside, and then we start to look at this level and then 200-day moving average on the downside for the dollar versus Swiss. Let's see if we see any clues from the hourly chart. And off the hourly chart, we did see the price for the most part all through here, this move to the upside, stay above the 200-hour moving average, like one of the other current. You know, we saw this fake move to the downside here, reestablished, and then on Wednesday's trade, we started to see a crack below the 200 in early Asian session. On Thursday's trade, we moved back higher, but held resistance against the broken trend line through here, and that opened the door for downside, breaking below this swing area through here between 98, 90, 60. 98, the 96.86 and 97.07, moving all the way down to another swing area here, swing high, swing high, swing high, swing low right here. Found support against that level, where 50% of this move to the upside is close resistance in early trading, and as I mentioned, the 100-day moving average have to stay below that level going forward to keep the bears in charge there. Dollar versus Canada. What we saw in trading at the highs through the month of August, as the market moved up to retest this high here on the first day of the September, and then on this day, this week on the 7th, we saw the price move again back up to that high, those highs, and found sellers. We did break above this trend line here, which has a high, and break above that failed. Break above that failed, try to reestablish the level here, break above and fail, and move back down on Thursday and Friday's trade. So staying below this level is more bearish. Also, watch this level right here between the 130.74 and 130.83 level. We have a swing high, swing high, swing high, fail break, another break to the upside, try to hold support, break below it on Friday. Watch, you have to stay below this 74 to 83 level on the top side for the dollar versus Canada, keep the bears more in control. Off the hourly chart, fell below the 100 and 200 hour moving average, moved down. We have, you can see the highs through here, how that stalled on Wednesday's trade, forced the price to the downside. 50% retracement down here, 129.67 is a target. Then come down, and traders will start to look toward the 100-day moving average if the bears remain in control. On the top side, keep an eye on this level between 130.76 and 130.92. Some swing levels through here, swing high, swing levels through here. Swing low, swing high. You can see the idea through there. I think it goes back further, if I'm not mistaken. Yeah, if we really go back to these levels through here, that's what defines this area. So blurry rise, you see a break up here. Blurry rise, see a break up here. So only a couple breaks above this area through here makes this level somewhat important for the dollar versus Canada. So keep that area in mind in your trading this week. Let's take a look at the Aussie versus US dollar. And our low price that we saw this week retested this old trend line, also retested the low price from the month of July through here, and found support buyers against that level, giving somewhat of a push off the lows. Springboard to the upside. We are below the 100-day moving average, and trying to move and stay above this swing area between 68.28 and 68.59. Get above the 59 level, it'd be more positive. On the hourly chart, we're seeing a little bit better bullish bias here for that currency pair, in that we broke back above the 200-hour moving average. We do have a resistance against this trend line coming into the new trading week. That looks like it cuts across around the 68.82 level, and moving down through here. If we're able to break above that level, get to the 50% of this move to the downside, those would be targets, along with the 100-day moving average on the top side, and the 61.8% retracement, which comes in around the 69.66 level. In the short term, what you don't want to see is a move back below the 200-hour moving average. We did move it above it here and failed. We did move it above it here and stayed above it for a few days. This is only one day to the upside for the Aussie versus US dollar, so we're sort of incongruent with this period right here, but don't want to see a failure back below the 200-hour moving average to take the price further to the downside. Finally, let's take a look at the New Zealand versus US dollar, and similar to the Aussie versus US dollar, we broke above the 200-hour moving average, but in this case, we haven't seen a move above the 200-hour moving average like we saw in the Aussie versus US dollar with the failures through here and here. Here, what we saw is that resistance held against the moving average. Sellers came in early against that level, and then this week we saw the price on Friday move above, but quickly come back down after testing this swing area between 61.55 and 61.66. The price moved down back toward the 200-hour moving average, but it stayed above, which in the short term keeps the buyers in play, hoping for further upside momentum for the New Zealand versus US dollar. Stay above the 60.049 level and the 60.66 level. That's 60. 60.849 levels. 0.60849, 0.6066 are the levels here on the downside that we have to stay above in order to keep the hopes for further corrective action in the New Zealand versus US dollar. So there you have it, a look at all the major currency pairs going into the new trading week. I think there's some key technical levels that you can grasp onto, that you can lean against, that you can use to your advantage in trading next week and determining the bias, understanding your risk, defining your risk, limiting your risk, so on and so forth. That's what you do as a trader. Hope this helped you. Good fortune with your trading this week. My name is Greg Michalowski. Bye-bye now.